G'day folks, welcome back to another update for natural gas. Now it's hitting resistance at the moment. Before we go any further, make sure you hit that like and subscribe button to support the channel, and also reference the +1 videos to get a deeper dive into our trading strategies. Global natural gas markets entering late 2025 remain structurally tight but highly volatile. Demand growth has cooled, especially in Asia, while Europe and North America carry much of the incremental demand, often for electricity generation as renewables and weather-driven dynamics fluctuate. On the supply side, increased LNG exports, especially from the US and other LNG producer nations, provide some cushion, but reductions in Russian and piped European supplies, plus constrained storage, have kept the balance fragile. Geopolitical instability, notably war, terror, risks in the Middle East, and disruptions stemming from post-2022 adjustments in Russian gas transit, continues to be the single biggest wildcat. Short-term price spikes remain likely whenever conflict flares, but over the medium term, note to 2030, ramp up in LNG export capacity may help stabilise supply and meet growing demand, especially if Asia rebounds. That said, if demand fails to materialise or if further geopolitical shocks occur, gas prices could swing wildly, underscoring that natural gas remains an energy commodity with elevated risk reward through the rest of the decade. So here we have the natural gas weekly chart, and as you can see on the price, it's well above the moving average, giving us a nice big bull run, and also on the CCI, but notice a bit of a pullback on the CCI, so you might see a retrace there. And if we go to the daily chart, that's also showing a potential resistance up here at 48.15. Now I've got almost a triple top there versus a declining highs on the CCI. So that's a bearish divergence pretty much already set up. And if that was to pull back from there, let's take it from that high. It's almost about reaching that high, so I'll consider that a bearish divergence. We take it back to that significant low before the divergence started. And we can expect a pullback as a minimum in that 23-38% range. So just be cautious about going long. I'd like to see this CCI break higher than moving average, but at that stage, the price would also have risen as well to invalidate this bearish divergence. That's on the daily, and on the hourly, any micro moves, you can see that it's been nice and bullish for the last couple of days. After this bearish divergence back here, dropped off well below 100% retrace of that Fibonacci range. Now in terms of the bullish trades, taking long trades only according to the daily, and that daily chart, just to go back to it for a moment, just to demonstrate, you would have been going short during this period according with these arrows, and then going long from about the 3rd of September, since the price is well above the moving average in most of those instances. What that looks like on the back test is this. Again, I like to trade this with the moving averages on the hourly. So again, going direction of the daily, you would have taken these long trades and closing it out when the moving averages started to turn down, like it did here, after a bearish divergence. So no short trades in that period. Then going long again at that little range, closing it out there again. Again, notice the CCI dropping off in the price. Avoid short trades, going long again at that point. Both the CCI and the price started to increase, and you would have let it run, and you would have closed it out somewhere there. And that was giving you an early warning with a bearish divergence as well during that period. But again, following the daily trend predominantly. Avoid that trade short, going long again from there. Again, notice that sharp drop off on the CCI. You would have closed it out somewhere in that range there. And each of these points where it drops off, you'll notice there's a drawdown on the profitability, and you would have avoided that drawdown. So again, running through the whole process, long, let it run, and you would have closed it out and avoided that drawdown. And the latest stage would have been going long at that little period there, and you'd probably still be in the trade. Wait for the moving average to start to turn down, and you would have started increasing your profitability. That's your profitability chart, showing upward momentum, which is what you want. So here we have the weekly BOIL. Now you'll notice here the price has been below the moving average, so predominantly bearish momentum here. If you're trading on the daily, go in the direction of the weekly. But at the moment, you would have closed out any short trades once that price or the CCI moved into that moving average range. So at the moment, neutral, both price and CCI are within that moving average range. So wait for it to break either above the moving average or below to take long or short trades respectively. You're trading on your hourly, this is the daily chart, and I've got here some arrows indicating going short from this period and going long from this period. Now you might ask why you're going long from this when the price and the CCI is breaking below. When you get a very flat, constricted moving average range, especially in the price like this, look it was here, that's consolidation. This could go either way. And quite frankly, using the average down approach, giving it time to breathe, both long and short positions would have worked either way here. Now, this eventually broke higher, purely by, I suppose, chance, if you like, and you would have been going along during this period on the hourly if you're trading in accordance with the daily. On the 1 hour chart, again showing you here, according to the daily trend, you would have taken these long trades, avoided trading short, taking long trades and so on. And what we look predominantly here on the 1 hour chart before you go to the back test is any divergence. And you can see there the price and the CCI are pretty much moving in conjunction with each other. So there's no real divergence that I can see there. Looking at the back test starting from about the 20th or the 29th or 30th of September, and again this is according to the daily trend. This is the 1 hour chart. You would have taken those long trades and closing it out when the moving average band closes down. So some of these profits are better than others. Again, avoid going short and going long again during that period. You can see the profitability rise. Again, avoid going short, going long again during that period. You possibly could have closed it out there with that gain. Then you would have got back into it, and then closing it out again with that decline on the moving average band. Going long again there, closing it out. And here you probably start to take long trades again from that point on when the moving average band starts to turn up. This is KOLD. So on the weekly, first off, the price and the CCI below the moving averages, so taking short trades only. And there's no divergence to be concerned about there. On the daily, it's bearish momentum at the moment. So if you're trading on the daily time frame, you're trading in the direction of the weekly, and this is showing you taking short trades whenever both you get a fresh breakout, and that would be a fresh entry at that point there. So you'd be short at the moment on the daily. If you're trading on the hourly, you'd be going in the direction of the daily. So again, taking short trades, and there's no divergence that I can see. The last divergence we had was this bearish divergence back there, and that dropped off in our 23-38% range, almost down to the 50%, bounced, and it's fallen right through. On the hourly, the main thing we look at here is any divergence. We had a bullish divergence here, bounced, hit our target, then retreated back below the moving average range. So again, we're going short in the direction of the daily, don't forget, from about the 20th of October from this period. And what looks like on the back test, going short from this period, the 20th of October, going short during that period, closing it out at that point, avoid going long, going short again there, let it run. The moving average band is still in a decline. You may have possibly closed it out there. In this case, it kept going down, and then you finally closed it out at that point after seeing this bullish divergence. Bounce, hit our target, avoid going long, probably entering a short position there, closing it out, and you'd be out of the trade at the moment and entering a fresh trade somewhere in the last few hours of that position there. And for UNG on the weekly, the price is broken above the moving average band and CCI as well. So taking long trades on the daily, if you're trading on the daily chart, you go in direction of the weekly. And notice here as well, we've got a bullish divergence, and that looks like it may go higher. So again, looking positive at the moment on the weekly. On the daily, that's also a fresh breakout above the moving averages. So you would have been going long according to the daily trend if you're trading on the hourly, or if you're trading on the direction of the daily based on the weekly, going long at that point. And again, that was also a result of this bullish divergence versus slightly lower lows on the price, and you would have been going long from that period on the hourly, 17th of October, so just keep that in mind. And on the hourly, it's been fluctuating above and below, but predominantly you would have taken long trades here, and that was a fresh breakout there on the hourly. So what that looks like on the back test, going long according to this period on the, we said the 17th, 18th of October. Again, you would have been going short from that period according to the daily, and then started going long according to the daily. And that would have been, again, going long during that period. The trade's open and closing it out at that point, making a little return. Avoid going short and opening long trades again, long positions, let it go. And you may have closed it out there possibly with the moving average band constricting. It could have gone either way, and it finally broke higher. Even if you did close it out, you would have gone long again when the price broke above the moving average band. Let it go. And closing it out there, avoid going short, going long again there, it might have been a break even, avoid going short, and you probably would have started a new entry there on that last couple of hours of trade going long. If you'd like to get some share trading ideas, we do a bullish scan each weekend. We just did one yesterday. These are some of the trades we've taken and closed since the 21st of September this year, and that's returned 13.26% of revenue based on these share trades we've taken.
This looks positive.
So again, we run a bullish share scan each weekend. The latest one we did yesterday. Links in the description below. So hit that like and subscribe button. Thanks for watching, and we'll see you in our next update.